welcome, folks. This is David White sitting in for the one and only Tom O'Brien for the first hour. We'll have Steve Rhodes in here for the second. We are looking at the S&P at 1903 right now, up 16.5 points on the S&P cash. We've got some fairly decent volume out here, but certainly 2 weeks ago we probably would have said this volume was great. But today, a little lackluster compared to the huge volumes we were having from, Tuesday on. I look at, if you listen to Tom O'Brien regularly, he will be talking about the floor-traded volume at the New York Stock Exchange tape. I use something called the New York Stock Exchange Consolidated Tape. It's both the American Exchange and all shares traded, whether they're traded at the New York Stock Exchange 2, and that includes all shares traded on ECNs, maybe off the board. Right now we've got about 2.36 billion. We were mostly hitting $3.5 billion last week at this time. So a little bit coming off the bloom coming off the rose for volume again and coming back to somewhat narrow levels. If you listen to my show, which precedes the Tom O'Brien show at 2 to 3 each day, you will be able to listen to my show from today. But basically, I was saying this last Friday, so it's not new, but what I'm looking for is this market to come back up. You get these wicked down moves in, even if this is a bear market, which is not confirmed yet, you get a wicked down move. Every bear and his dog is out shorting the markets. Normally, the pattern is to push down early in the morning, and that is the weak hand shorts and retail traders who have not been through many of these patterns before. By the end of the day, they're covering. And this happens so many times that I've pretty much learned to stay away from short covering rallies if I think that the broader market or long-term move is down. I may catch something like I did last week, which was, of course, a violent retracement of a bear move. But at the same time, you want to get out of that and get out of that party fairly quick. You don't want to be hanging around fairly long if you are playing counter moves against a fairly it'd be tough for anybody to say that they weren't probably a little less bullish after last week. So anyway, printing out here at 1903, I was thinking that the market could pull back up to 1925, 1935, maybe as high as 1945. We'll see over the next few days or so. But there is another phenomenon going on, and that is known as options rollover. The monthly options expired while weekly options are becoming more and more prevalent. There's still a huge monster amount of options that expire monthlies. You won't find many of the people on Wall Street using weekly options except in rare cases of earnings. And for that point, that you want to be looking at just what can you glean from the next 2 days, and normally it's nothing. When you hedge your position as an option market maker, let's say that you've got a put, you're going to buy the equity on the other side of it and zero your position until the option expires. That means that you have to come back in today and sell it. If you were basically selling calls, that means that you need to be short the other side of that, so you're shorting the equity. So what you get on a day like today is a lot of fighting, and I'll call it chop. And that chop in the market actually will tend to get out of the market probably by about Tuesday, usually early afternoon. It may take all the way till the close of tomorrow. So I don't really spend a lot of time putting in market action that happened on expiration day and the 2 days that follow, where these options are rolling over. Of course, now we're into October, which means that you're going to have options that are being put out at 60 and 90 days that will take us almost through the end of the year. And we're going to get a good idea, at least what the option market makers think that this market can do, and I'll be looking at those. Like I said, I don't like to have a lot of positions on that Monday and Tuesday after expiration. I like to see where the market is really moving on Wednesday. I had some really big trades last week. We're going to celebrate a little bit here at TFNN. You can go to the front page and check out my daily newsletter, The Path of Least Resistance. We're giving you a special deal where if you want, you can get 30 days for $30, 30 for 30. And if you are a subscriber to my newsletter already, we're offering the lowest level and price ever to re-up and continue subscribing. So go to the front page of TFNN, and you will see it in the banners right there, and take a look at it. Anyway, bouncing a little bit, we probably spent the last hour at 1899, and now we're up a few more points. Again, I'm going to say that it's not going to be uncommon to see this pattern over the next few days, and that is people that now believe that the market's headed down are not going to get and give a chance for this market to pop back up very far. And I think you can probably see that over the next few days. Sour opens and not so sour closes, and we're kind of going to tick or stumble back up to a level, and at that point we're going to decide whether this market's headed higher and we had a false breakdown, and or whether it's time to pull the cord again and get a parachute because it's going to be a long drop. But we'll probably find out, I imagine, late this week. Good time to check out my newsletter. On this day in 1803, the U.S. Senate ratifies the Louisiana Purchase Treaty, under which the U.S. pays France less than 3 cents an acre for 828,000 square miles of territory stretching from the Mississippi River to the Rockies and from the Gulf of Mexico to the Canadian border. Probably the best 3 cents an acre ever spent, I would imagine. But on this day in history. We're going to get into some of the charts moving out here. Of course, after the bell, we have Apple. And the big story on that, of course, is that they picked today, their earnings day, to also start rolling out Apple Pay. Not a lot of volume before this. My guess is that even if the numbers are not good, they're going to be good from the new CEO, who's under a lot of pressure to perform. There's a lot of things that you can do to move earnings up. So I'm not expecting the earnings to be bad. I suspect that they're not going to be as good and wild as most people thought. I'm looking for this stock probably to pop probably around 101 and to 101.70, unless there's something that we haven't heard about that's in those stocks already. What do we have? Oh, I just wanted to look at the current price on Apple, $99.62. If it should go over 101.70 on the gap up after earnings, I would really be watching it over the next few days, because that is the battle line for Apple. And right now, 48 million shares as we speak. Of course, the disappointment du jour today is IBM. If you've been listening to Tom O'Brien's show and we all knew this was a huge financial engineering. The only question was when the merry-go-round would stop, when the music in the musical chairs would be turned off, and a lot of people would be sitting or standing hoping to find chairs. That day came for IBM today. They've been financially engineering this company for 2 years with share buybacks, with bogus upgrades. And when you read Tom's book or any book on investing, normally you'll read the normal cycle, which is the markup cycle, the distribution cycle, and, of course, the crash cycle when everybody is left to pick up the pieces. What we've seen in IBM is just that. It's been in a wild trading range from about $200 to 180 for a long time. Every time you thought things couldn't get worse, they did. IBM would buy back more of their shares, making their EPS look better. To the casual observer, they would not see the tree that was rotting from within. We will be back after this break.